markets do the same kind of assessment of data and incoming economic information and financial market economics as the FOMC members do. And, they may have a different view of the economy than we do. They may not, necessarily agree on where we see the economy going. We're doing a careful risk management is sort of the key mark of our policy at this point in the cycle. So, we're trying to make sure that we hit our dual mandate goals, which in the US are maximum employment and price stability. Inflation's still too high, it's above our 2%, but we've made very good progress. We just need to make sure that we're going to get back to price stability in a timely and sustainable way. And we have, in some sense, a very good real side of the economy in terms of unemployment is low, employment growth is pretty strong, and our spending data is stronger than expected. So again, we have sort of the luxury, if you will, to really make sure that we have full confidence, increasing confidence that inflation gets back to our 2% goal. And that's kind of the path forward. Certainly, I think that's the proper, appropriate policy path at this point, given what we know how the economy is evolving.
So are investors seeing something that central bankers aren't?
Well, again, I think you have to, talk to the investors to see why they are. But, markets move, right? So, the Fed tries to do the best job we can of explaining how we're seeing the economy, what the risks are around the outlook, and then also what we think the appropriate policy path is if the economy evolves as we expect it to do. If the economy evolves differently than expectations, then we're going to set our policy path perhaps differently because of, how the economy is evolving. But we're always going to try to explain to the public what our rationale is for our policy and what our, feeling about what the economy is and the risk. And markets will either adapt to that or not. We saw markets move in the US after the FOMC statement came out, and then after Chair Powell's, press conference. So again, the markets are reacting to incoming information in a very timely way. And we're trying to do the best job we can of communicating how we see the economy and how we think policy should be implemented to appropriately balance the risks.
In the US, markets are betting a May or a June rate cut will occur. What do you need to see at the central bank to make that happen?
Well, we're going to look at all the incoming information, and it's not just the data that comes in, but also we do a lot in our bank and other Reserve Bank presidents to reach out and talk to the people on the ground, if you will, business leaders, manufacturers, community representatives in terms of what's happening in neighborhoods and other community areas. So we have pretty good reconnaissance directly from people who are engaging in either making something or setting prices or hiring people. And that information is going to be important. Right now, we have a strong labor market. It is moderating a bit in some of the outlooking factors, like our businesses tell us it's much easier to hire this year than it was the past 2 years. But still, in different sectors, there's some scarcity. If healthcare is one of them. Wage gains have moderated a bit over the last year. At the beginning of last year, businesses were thinking that the average wage gain would be 5%. Now it's thought to be 4% going forward. So there is this moderation going on, bringing supply and demand in the labor market back into better balance. And the spending data has held up quite well. If you look at where people thought the economy was going to be at the beginning of last year for this year, and it came in stronger last year. And again, we have some pretty good readings going forward, but it is moderating. And that's kind of we need to see that moderation continuing according to along the lines of the forecast. And we need to see further progress on inflation. So we had remarkably good inflation numbers last year. And what I mean remarkably is it came down faster than expected. We just need to see more of that to gain confidence that inflation really is going back to our 2% goal in a sustainable way. And that's kind of just a matter of looking at the data, and it's balancing the risks, right? The risks, to our dual mandate goal are very important to balance those. And right now, the economy, in terms of maximum employment, is holding up very well. And it's really this inflation that's coming down. But both parts of the mandate now are in our view, right? They're in the frame. Earlier, when inflation was very, very high and labor markets were strong, we had to concentrate on the inflation part of the mandate. Now, as things get into better balance, we should be looking at both parts and balancing those risks.
There's been some pretty strong data coming out of the US recently. The January jobs report a testament to that. How confident are you that the next move will actually be down and not up, as the central bank in Australia has left the door open to?
Well, you never want to rule anything out because the economy could evolve very differently than anticipated. But my feeling is that we are at a peak rate, and that the real decision going forward is, what's the appropriate time to begin reducing the degree of restrictiveness. So, my feeling is if the economy evolves the way we expect it to, then later in the year, I'll be sufficiently, confident that we'd want to start bringing down the nominal Fed funds rate, because one of the key pieces of data here is inflation, but more importantly even is inflation expectations, which is forward-looking. As that continues to come down, and it has been coming down, the near-term inflation expectations, that means that we probably should be adjusting our nominal Fed funds rate in order to not be inadvertently becoming more restrictive. But the actual timing of that really you have to evaluate the incoming data and the risks around that. And again, if the economy evolves as I expect it to, then I'd be comfortable feeling that it's going to be later this year that we will be probably in a position to be able to start normalizing the interest rate back down.
So do you still hold the view that the Federal Reserve in the US will cut interest rates 3 times this year?
I haven't formulated my new forecast because that'll be at the next meeting, the March meeting. But I think that's about right. I mean, I think that's kind of the way I'm still seeing things going forward. Again, balancing the risk to both parts of our mandate. But again, you don't prejudge, right? The economy could evolve differently. We could get a different picture from our business contacts and our regional contacts about what they're seeing out there and what's coming. And there are risks around the outlook. So we can't necessarily, predict what's going to happen. We do the best job we can, but there could be shocks that, hit the economy. And then we'll want to make sure that we're at the appropriate policy stance, given all the information that's come in. So right now, if I had to write down a forecast, that's probably what I would write down. But again, we have to be very cognizant of all the information that comes in and do our forecasting based on that. And then also be very cognizant of the risks around those forecasts.
What are the risks to that forecast?
I think geopolitical tensions have continue to rise, and I think that does pose a risk to the forecast. It could affect oil prices. It could affect financial conditions and financial stability. So there's things that we should be very attuned to. And then China's is slowing down. That is another risk that we have to see. I think in the US, we had the tensions and stresses in the banking system last March. Banks have moved beyond that. The system has moved beyond that, but there are some banks that haven't diversified their funding sources and are relying on uninsured deposits. And some of them have commercial real estate assets, in particular office buildings, that have to reprice, and they have to reprice at higher rates. So there's some tension there in terms of, proper risk management that the banks who face that situation have to be doing. So you don't want to rule out that is another source of potential risk. Right now, our banking system is financially stable and banks are safe and sound, but that would be another risk I'd have on the ledger.
US Fed Chair Jerome Powell has said this week that much of the disinflation that we've been seeing is a result of the healing of supply chains. How concerned are you that attacks on container ships in the Red Sea could push up that supply chain inflation again?
I agree that a lot of the great progress we've made on inflation has been supply side driven, which means that I don't think we should count on the same rate of progress this year as we got last year. I still think there'll be progress and inflation will continue to move down. So far, when we talk to our contacts about whether they've seen any effect on their operations from the tensions in the Middle East, they say no, it's been very minimal. And they also say that, since they've done a lot on supply chains, that so far the higher prices of the Red Sea shipping is not affecting. They think they'll be temporary and it's not going to have a major impact. But that's something we should keep watching for, because you're exactly right. One of the benefits has been that the supply chains, global supply chains, have basically gotten back to normal. And at the same time, firms have taken really good steps to diversify those supply chains so that if there is if something does happen, it has less of an impact than it did when the pandemic hit. So those two things combined make it, less of an impact so far, but I think we should be watching for that too.
So if supply shocks are broadly done and most of the inflation is now being driven by demand, is it going to be this so-called last mile that's going to be most challenging to get inflation back to target sustainably?
Okay, so the research on this, of course, is there both sides. My own view is that we should be cautious in thinking that we're going to get the same rate of progress this year as we did last year, precisely because both, there's more balance in the labor market, supply and demand, as well as in product markets, there's global supply chains. So I do think that, we can't count on as much help from the supply side. And typically when inflation does decline, that's an important factor. And the underlying inflation rate tends to be a little more persistent. So I do think that, we're going to have to assess that as we go forward. And of course, we'll see the inflation data, so that'll give us a good indication. But I think if I were going to stand today, I would say we shouldn't be just assuming that it's going to fall at the same rate as we've had, because the contributions from the supply side adjustments will probably be diminishing.
Is it the case then that we're going to have to see interest rates higher for longer?
Well, I think the market got ahead of itself a little bit. Remember before the meeting, they were thinking that the first cut would be March, right? So again, I think we've just got to wait until we get more information. I think we're in a very good position, that the economy is in a good position, and our monetary policy is in a good position, so that we can do that assessment. So, as I said, employment is solid, and the spending data have held up better than expected in some sense. And that gives us sort of this leeway to make sure that inflation is on that path down. So I think we have to just keep watching, assessing, and then, if inflation keeps coming down and if it comes down as fast as it did before, then we can adjust our policy. If it turns out that it's stalling or it's being more persistent, then we can adjust the other way. But right now, monetary policy seems very well positioned to sort of adjust. And I think that's going to be the important thing going forward, is to manage those risks and set our policy to achieve both parts of our mandate.
In Australia, our central bank is undergoing a restructure, and it's very likely some changes will soon be legislated, which will mean publishing unattributed votes on rates decisions and more public communication from board members, similar to the situation you have in the US. Do you think this type of transparent communication is constructive, or can it create too much noise around the central bank?
I honestly I'm a big fan of transparency, and I think having the public see how other policymakers are thinking about policy, monetary policy, I think is constructive. I do believe that we should be transparent, and we owe the public a good communication about what our rationale for our policy decisions are, and how we're seeing the outlook, what our best, forecasts are of the outlook, and what the risks around the outlook are. Policymakers are not prescient, but we do owe it to the public to really explain how we're seeing things. How do we think the economy is going to evolve? What do we think could happen? That's not necessarily the baseline forecast, but what could happen, so that the public's better informed, and then they can form expectations for policy, and then actually makes monetary policy more effective. So I have always been a supporter of communication and being as transparent, because we have to give the public the information they need to hold us accountable for our decisions.
Loretta Mester, great to speak with you.
Thank you for having me.